Hey everyone, my name is Jack, and if you haven't heard, the Fed just recently cut interest rates by 0.5%. Find out what this means and why the Fed even changes rates in the first place in this video. The big rate that people refer to when the Fed cuts interest rates is the federal funds rate. The federal funds rate is the interest rate that banks charge each other when they lend money to each other. And when that number is lower, then the interest rates that they can give to consumers and businesses are also lower. At the same time, it affects some other things that I'll go to in further detail shortly. But earlier this week, the Fed made the following announcement.
Earlier today, the Federal Open Market Committee announced a 0.5 percentage point reduction in the target range for the federal funds rate, bringing that range to 1 to 1.25%. My colleagues and I took this action to help the U.S. economy keep strong in the face of new risks to the economic outlook.
Now, Chairman Powell explained that the reason that the Fed was cutting back was mainly due to concerns around the coronavirus and the economic uncertainty that has come with the virus and the things that it has done to the economy throughout the world, not just in the U.S.
The spread of the coronavirus has brought new challenges and risks. The virus has afflicted many communities around the world, and our thoughts and prayers go out to those who've been harmed. The outbreak has also disrupted economic activity in many countries and has prompted significant movements in financial markets. The virus and the measures that are being taken to contain it will surely weigh on economic activity, both here and abroad, for some time. The magnitude and persistence of the overall effects on the economy, however, remain highly uncertain, and the situation remains a fluid one. Against this background, the committee judged that the risks to the U.S. outlook have changed materially. In response, we have eased the stance of monetary policy to provide some more support to the economy. We can and will do our part, however, to keep the U.S. economy strong as we meet this challenge. As always, our actions are guided by our congressional mandate to promote maximum employment and price stability.
Did you catch what he said there at the end? He was talking about how the Fed's main goal is to make sure that employment is as high as possible while keeping prices as stable as possible. In other words, the Fed doesn't like a ton of super quick volatility in either direction. It doesn't want to see prices raise super fast, and it doesn't want to see them fall super fast, since that instability can really cause a lot of pain either way. But really, the Fed is just trying to avoid this situation.
Ratios. Wait a minute. How did this happen? We're smarter than this.
Now you might be asking, why doesn't the Fed just cut interest rates to zero and create maximum growth? Well, there are some risks associated with that. When debt is so cheap that people can take it for literally nothing, sometimes you get hyperinflation, where prices raise too quickly to the point where other things can't keep up with it, like wages, and then you lead to all sorts of different problems, as super hyperinflation countries have shown us in the past. The US actually had a very bad period in the 70s, stagflation as it was called, where inflation and prices were growing super fast. A lot of that was actually tied to the oil embargo. But anyways, the Fed does try to avoid super high levels of inflation, since we don't like seeing that level of uncontrolled price growth, which causes more consumer uncertainty and could lead to a recession as well.
Wait a minute. How did this happen? We're smarter than this.
This is why the Fed will sometimes raise rates on occasion to cool the economy down and prevent people from overspending and prevent people from overborrowing and over-leveraging themselves because debt's so cheap. Now, the main reason that the Fed lowers interest rates at all is to try and spur economic activity, and it does that in mainly two ways. When the interest rate is lower, that is the federal funds rate is lower, banks can charge less on their loans. And when banks can charge less on their loans, more people will be willing to borrow those loans to invest in their businesses, buy homes, buy cars, take out more debt to do all sorts of other things. And that generally increases the amount of investment. At the same time, it also increases the other thing that the Fed wants, which is spending, that is consumer spending. Now, even though debt might be cheaper, the fact that the interest rate is lowered also generally decreases the interest rate that you'll get on a savings account or in bonds. And when savings account interest rates and bonds rates are lower, people are more tuned to take that money out of those accounts and spend it out in the market. Because if you're making 0.5% less on a savings bond or on your savings account, it's not as much of an incentive to keep it there. You'll take that money out and be more prone to try and invest it and make a higher return elsewhere, or just spend it on consumer goods, which both get the economy going and keep it propped up, as the Fed is trying to do in this case. The Fed's goal is to try and get ahead of economic recessions rather than actually let them happen.
How did this happen? We're smarter than this.
Because ideally, this half-rate interest rate decrease will help to offset some of these market decreases that we've seen in the recent weeks, thanks in large part to the coronavirus and other negative things happening in the economy throughout the world, not just in the US. This 0.5% decrease in interest rates hopefully will help to spur more investment in things like real estate or businesses that rely on a lot of debt, and might influence consumers to start buying more things as well while they are getting cheaper because of the price decreases, and because, again, debt is much cheaper, and that's savings in a lot of cases. When someone takes out debt and their interest rate's 0.5% lower, they have more money to spend on other things to help, again, other businesses and get the economy going. That's what the Fed's going for when it lowers rates. Conversely, when the Fed raises rates, it's actually trying to cool off the economy, or at least slow it down a little bit, rather than lead to super fast growth. Now, it's not that growth itself is a bad thing. The Fed does want to keep consistent growth, but that's just it. It wants to make sure that it is consistent and, more importantly, steady. Because super high, fast growth can lead to a lot of instability, can leave a lot of people out of work if things are moving too fast and there's too fast of change. And that's something that the Fed sets out to avoid, because if things move too quickly, prices may raise very quickly, faster than wages, and then you have people who can't afford things, and then sometimes there might be businesses that can't afford things, and then they have to lay people off, and then you still end up in a recession, even after a sort of bubble in a way.
How did this happen? We're smarter than this.
What happened before 2008 and that housing crash is a lot of what the Fed would also want to avoid. It doesn't want people taking out tons of debt to where they're buying things that are appreciating in value so unbelievably quickly that there's no way that other parts of the economy can actually support this. Now, there were other problems associated with the 2008 crash, but that was one of them driving it. Just the price growth itself was so massive that a lot of things couldn't keep up with this price growth, and then as soon as the bubble burst in one area, the whole system collapsed. That's obviously something the Fed wants to avoid, though that is more of a rare circumstance. We have more often, at least in the last couple decades, is when the economy is slowing down a bit and the Fed just wants to get it going a little bit again to try and create some more growth, and rather than lead to a recession just because of the sluggishness of the economy.
We're smarter than this.
So to review, the main thing that the Fed is trying to do when it cuts rates is to increase consumer spending and increase business investment through debt mainly. When things like bonds and savings accounts are less attractive, but things like loans are more attractive because of lower interest rates, that should spur more economic activity and get people spending again to where the economy can get going and start growing faster again. Now, how much of an impact this rate drop will have on the economy, it's hard to say. There's so many things that affect the economy. Monetary policy from the Fed is only one of them. It is a major one and could have a big impact, but ultimately only time will tell whether or not this change will make a huge impact over the medium to long term. But in the meantime, it might be a great time to take out new debt if you're trying to buy a piece of real estate, for example, as would be my case as I've been documenting on this channel. And it might be a great time to start trying buying things like stocks as the market decreases, but hopefully this Fed rate drop will help to re-increase the market over the medium to long term. But we'll see. Again, there's no guarantees. After all, I'm not a financial advisor, and this video is just for entertainment purposes only. If you like this video, be sure to give it a like. It helps the channel out a lot. If you have any questions or comments, be sure to leave them below. And be sure to subscribe to the channel. I post new videos on personal finance and investing every single week, and I have a couple series documenting my specific investment strategies, and you can follow those along too. And the final thing I'd like to say is to make sure to wash your hands with soap and water frequently. Until next time, take care.